Hi everyone, welcome back to my channel. So today's video is all about the ways to read a chart with no indicators pulled up. So hopefully by the end, this can help any new traders understand the value in precision over noise and skill over shortcuts. So let's just jump right into it. So the first thing to mention is the concept of positioning. So within this walkthrough, this is more of a strategic breakdown of why mastering pure price action will outperform overdependence on lagging indicators any day of the week. Now, we all know there's an indicator for pretty much everything: trends, momentum, volatility, volume. But what I've seen most common is that for some new traders, these indicators become the only form of confirmation. And truthfully, that's not always the best way to learn how to trade, because the question becomes, how do you know what's actually driving the stock directionally? Now, the answer is market structure based upon price action, since this is like the primary language of the market. So with that in mind, I do want to spend some time discussing price action so that I can show y'all a few examples. Now, for anyone new to day trading, price action is simply the movement of a price on a chart, nothing added, nothing interpreted. It's the candlesticks, the volume behind them, and the structure they form over time. Now, I know there is some debate on whether or not volume is an actual indicator. I will have it pulled up in this video, so we're just going to pretend that it's just an additional piece to the chart and not necessarily 100% an indicator. But again, I do know that there is some debate on whether or not it's considered that. But just for example purposes, we'll keep it on here as if it's not. Now, because of that, one of the key concepts I want to discuss is the candlestick formations. Now, this can entail engulfing patterns, dojis, pin bars, all that good stuff. But let me go ahead and zoom in just a little bit here so I can show y'all a clearer picture of what I'm discussing. So I want to start with this candlestick right here that we see formed at 8:34 a.m. And of course, y'all know I'm on Central Time, so that's why you'll see it displayed as 8:30 for me. Now we can see that this specific candle here is obviously bullish, and it is a strong bodied candle since we do see the length of the body is pretty extended. Now what's unique about this candle is that there is no upper wick that we see here at the top, and it does display a very short lower wick here at the bottom. Now, as mentioned, if you're brand new to trading, you may not know exactly what this candlestick formulates to mean and what it actually shows you as a full story or a picture on what's going on. So to break it down, you want to make sure that you understand the basic concepts of the anatomy of a candle. Now, I will make a separate video discussing that in full detail, but just to give a quick run through on what exactly is going on within this candle here, we can see obviously there's strong momentum to the upside. And of course, we know that the candle opened here at the price level of about $129.94. And the buyers pushed the price up to the high of about $130.95. Now at the low, we can see the price at $129.78. So essentially what this tells me is that when I'm looking at this specific candle, because there is no upper wick, the buyers were in full control from the open all the way to the close for the most part, because price kept climbing without pulling back before the close, and it closed at an absolute high of that session. Now, what this reveals about momentum is that this bullish candle has stronger buying conviction, and momentum is aggressive to the upside. Now, this is often shown in breakouts or trend continuations. Now, as mentioned, when we're discussing price action, a bullish candle with no upper wick is also a sign of strength, especially if it breaks a key resistance level or forms a new high. Now I am on the 2-minute time frame here, you can see that. So what this also can indicate is that on lower time frames, this might signal a clean push, useful for scalping and for momentum trading. So I mentioned all of that just to say that this can signal a clue that you may want to stay in this trade if you're entering into it, or that you're likely to see this trend continue to the upside, simply because there's no selling pressure to the downside in this candle at all. Now, the opposite is also true. So let's go ahead and take a look at this candle here at 9:06 a.m., following the day's high of $132.81. Now, this candle nearly presents the same exact thing that we've seen here on the bullish candle, but obviously in the opposite direction. We can see that there's barely an upper wick, but there's little to no bottom wick. So essentially what this tells me, again, it's a strong bodied candle, so it's obviously a strong push to the downside. But because there's little to no wick here at the bottom, it's telling you that the selling pressure is extremely strong since buyers were not able to take control to push it to the upside. Hence why the stock fell into this downtrend or this sell-off that you can see here. Now it did present a couple minutes of a few pullbacks, but nothing crazy. It still remained as a trend to the downside. So I hope all of this makes sense. Now another aspect of this is market structure. So you will see higher highs, higher lows. Of course, you're also going to see break and retest. And along with that, you'll see key zones of support and resistance, supply and demand imbalances. All that can take place within any amount of time on a chart. Now, as I kind of briefly touched on earlier, volume also can play a major role in the conviction behind movement. Not just the price, but the level of participation. So when we see candles that are large bodied and is backed by high volume, that's also an indication that the momentum is pretty strong in whatever direction the market is moving in. So now you may be asking yourself, okay, well, why does all this matter? Well, the reason why it's so important to know this is that indicators are derived from the price, but they do present lagging reflections at times. Now, price action gives context in real time, not conclusions after the fact. So you're not waiting on a delay when you're reading price action, you're simply understanding the charts. So y'all, I'm saying all this to say that the message is pretty simple. The chart already tells you what's going on, you just have to learn how to read it. And of course that can take time, so if you're brand new to this, just make sure you understand reading the charts daily will always be to your advantage. Even if you don't necessarily know exactly what's going on when you look at certain candles, still taking the time to understand conceptually what you see is probably the best thing you can do to your benefit in order to gain more understanding. Now, I am aware that in some cases, it's not that traders don't want to learn price action, it's simply just that they haven't learned to trust it. And that can come from an over-reliance on indicators, which stems from uncertainty, and this is something I had to learn the hard way when I first started trading myself. So don't feel like you're alone if you are one to depend on indicators. It's pretty normal because once you learn a few of them, you tend to become pretty comfortable. And there's absolutely nothing wrong with that, but you don't want to have a dependency on indicators. Because the truth is, many mistake complexity for sophistication. But in my opinion, clean charts force accountability because there's no external validation. You just simply have to know what's going on as far as what's driving the momentum, and if it shifts in a certain direction, you have to be fully aware of why it has changed. Okay, so with that in mind, one recommendation that may help new traders is to pull up two charts side by side, for example, when backtesting. One chart can be bare and the other can have a set of your favorite indicators. Now, what this allows you to do is to comparatively read the chart, but from two different perspectives. One from the viewpoint of how the market dictates the indicator's movement, and one from the vantage point of pure market analysis. So let me show y'all what this looks like. So I'm gonna go right here at the top, click on this, and I'm gonna have two charts side by side, but I'm gonna have AMD pulled up on both charts, and I'm gonna have this time frame set for 2 minutes. Zoom it in so y'all can see it a bit clearer. There we go. Okay, so on this chart here on the left, I'm going to leave it completely bare, but on this chart here on the right, I'm going to go ahead and add the indicators. So some of the most commonly used ones are of course going to be the RSI, so we'll start with that. I know everyone loves the RSI, so we'll pull that up. We can also have like the MACD pulled up. I know people love to use the MACD as well. Pull that up, apply and OK. I'll also display the exponential moving average because that's a pretty popular one as well. We'll just use one for this example. Put that up there. Perfect. Okay, so now we have three indicators pulled up here on the chart. I'm going to zoom this in just a little bit so that we kind of have same kind of viewpoint from the left and the right. Okay, so obviously this chart here on the left is going to offer clean analysis on the price levels, which is pure reading of the candlesticks. And then here on the right, of course, we're looking at all these indicators. So we can clearly see the difference in the clarity versus the positioning and how you can prioritize being concise but having a little bit more of a clouded view. So the first thing to pinpoint is obviously going to be here is the RSI. We know that once it crosses above 70, this pretty much is a signal that indicates that it's in overbought territory. And then of course we know that the opposite is true. When we see it below 30, we can see that the stock is actually in an oversold status, meaning that the sell-off has been overextended. But let me show you the difference in how you can tell based upon just reading the charts whether or not it's important to use this as a form of confirmation or if it's best to just go ahead and look to the viewpoint of a bear chart. Now with the RSI, when we're considering it in this overbought status, it looks like it stayed within this realm until about 904. And we can see here it kind of dipped below 70 at that point. But when we go ahead and look at 904 on this chart here, we can see that it's showing us the day's high, of course, and then we see this strong bodied candle presenting all of that bearish momentum. And this took place at 906. Now at 9:06 on this chart here, we can see that the EMA is kind of cutting through this specific candle, but the height of the candle is still trending above the EMA. Now in real time, this may cause some to be faked out with the trend continuing to the upside because they see it's still trending above the EMA. However, in all actuality, this just presented the start of the decline for the day for the stock. But in real time, you may not have caught it immediately simply because you had this indicator showing you that it was still above that exponential moving average. Now, of course, it was short-lived, so it may not have been a full shakeout for an extended period of time. However, it still can present an issue. So I hope y'all understand what I mean by that. So now again, if we go back to the RSI and we're looking at it in this oversold state here, we can see that at about 10:02, the stock began to pull back from this oversold status and kind of enter above 30. Now it was a slow climb to the upside here, and we can see that kind of reflected. However, we can see the EMAs, we can see that the candles are still trending below the exponential moving average. Now in this consolidation period here, we can see the status of the RSI. Now once we see that the stock did go ahead and extend to the upside, we can see that the EMAs kind of reflected that as well because the stock is now trending above the exponential moving average, which is completely fine. However, if you were to comparatively look at the volume bars here from the beginning, we can see that there was strong momentum to the upside when it did push. Versus when we're looking at the extension to the upside here, the volume is fairly moderate, which also dictates that the stock moving to this specific direction of the trend wasn't as heavily extended. Now, would you have been able to spot that without having the indicators pulled up? It really just depends on the trader, honestly, because every move is super calculated when we look at price action. Now, if we're also considering MACD, kind of same thing. I won't go over this in as much detail simply because I don't want this video to be too long, but y'all can kind of see what I'm saying as far as the MACD as well. There is a bit of a delay on some aspects of it, not 100%, but again, indicators are not perfect. And because they are not perfect, they do tend to lag a bit, to kind of slow behind the price action, hence why it can slow down your trades or your analysis in some aspects and in some capacities. Not saying it always happens, but it can tend to mess with your trading psychology when you're brand new and you're not fully aware of what's going on. So now I want to discuss how to respond to what price is telling you. Now with this concept in mind, your chart should reveal a few things. One, where price is rejecting. You always want to be able to pinpoint wick rejections, false breakouts, or any other extension to the downside. It's also important to know where liquidity sits, and this could be based upon higher highs that have been shown for the day. It could be lower lows. It could also be breakout traps. Now, where market structure breaks, this is where trends also shift direction and where volume can also confirm conviction. So for instance, you want to make sure that your daily time frame is helped to identify the structure. So whether you're on the 1 hour, 15 minute, it doesn't really matter. Your execution should be based upon what you see. And then you should definitely accompany that with clean support and resistance because the volume and the candlesticks will pretty much give you everything you need to know as far as what to anticipate as the next move. Oh, and another thing that I did want to mention in reference to the MACD is that you don't necessarily need the MACD to see if buyers are in control. You can look at the strong-bodied green candles and they'll tell you if it's near a support zone, that there's aggressive moves in the buyers. You can also look at the long wicks on resistance to see if there's signs of exhaustion. I meant to tell y'all that as well. And then if you do see inside bars, this can be where compression is before the expansion. So I say all that to say that break and retest setups can be equivalent to market confirmation, not just breakout chasing. So definitely something to keep in mind when you're looking at the MACD. And then one of the last things that I did want to discuss in this video is that reading price is an acquired fluency, y'all. It will take time. You don't learn it once. You observe it daily until it becomes instinct. And one of the benefits to this is that noting your interpretations builds pattern recognition. So when you see the certain price structures, you can better plan for your trades. So maybe take a screenshot of setups to create your personal playbook. One example of this is some of y'all may have seen my live trades on Tesla. And in both of those videos, they both presented the exact same pattern. So this type of understanding of the setup allows me to trade the same move repeatedly to win trades because the structure is shown over and over. And then to go along with that, another aspect of this is from time to time, you may want to start back testing without indicators because this forces clarity over the complexities of a chart with a lot of noise. So the best takeaway is that price action is not just a technique, it's the foundation of every professional trader's decision-making process. Because all in all, the market already tells you the story. Most just never slow down enough to read it. So y'all, my main message in all of this is that if you need to, clear your charts, study the movement, and you'll start seeing things indicators will never be able to teach you. Key zones and key levels can always be drawn based upon just reading the candles and understanding how they form based upon what you see to ultimately make the decision on what you should do next. So all in all, that was just the main message of this video. So yeah, y'all, not to make this too long, we're going to go ahead and just wrap it up there. That'll pretty much do it for this video. So if you found any of this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.